The US economy is at record highs. Stock markets are near all-time highs. AI spending is exploding. And yet, millions of Americans feel broke. That's not a contradiction. It's a structural problem. If the economy is so strong, why does everyday life feel so expensive? Because the economy you see in headlines is not the economy people actually live in. Rent keeps climbing. Grocery bills feel heavier every month. Healthcare and insurance never seem to stop rising. Yet, we're told this is a great economy. Here's the reality. The US doesn't have a stock market problem. It has a cost of living crisis. Nearly 9 out of 10 Americans say affordability is getting worse. More than half of households struggle to pay monthly bills. That's happening while the stock market sits near record levels. Over the last 5 years, grocery prices are up around 30%. Housing costs have jumped more than 60% in just 6 years. A bigger share of income now goes to essentials, not savings, not security, not the future. This is what financial stress looks like before it shows up in markets. And this is where many people get confused. They ask, if markets are strong, why isn't life getting easier? Because markets and daily life respond to different forces. Asset prices respond to liquidity. They respond to debt. They respond to interest rates and financial flows. Daily life responds to prices, wages, and borrowing costs. And right now, those two worlds are moving in opposite directions. Let's talk about high interest rates. High interest rates don't just slow down big investors. They hit households first. Higher rates mean higher mortgage payments, higher rent, higher credit card balances, higher auto loans. Even if wages rise, a larger slice of income disappears into necessities. That's why people feel stuck. They're working more, but moving nowhere. That's not growth. That's financial stagnation dressed up as success. Think about it. If your rent goes up 20%, your grocery bill goes up 30%, and your credit card interest jumps above 20%, does it really matter if the stock market is at a record? This is the disconnect. At the same time, government spending keeps expanding. That spending doesn't come from nowhere. It's funded with debt. And when more debt enters the system, interest rates stay higher for longer. That pressure spreads everywhere. Housing becomes less affordable. Small businesses struggle to borrow. Consumers cut back. This is how an economy weakens quietly. But there's another force making this squeeze even tighter, and most people don't connect it to their daily lives. The AI boom. The AI boom isn't just a technology story, it's a capital story. Artificial intelligence requires massive infrastructure, data centers, advanced chips, energy, power grids, cooling systems. All of that costs money, a lot of money. So tech companies borrow, they issue debt. They pull enormous amounts of capital into AI expansion. And that capital has to come from somewhere. When tech giants and the government borrow aggressively at the same time, they compete for the same pool of global capital. And when money becomes scarce, it becomes expensive. That pushes borrowing costs higher across the entire system. It tightens liquidity. So while markets celebrate AI headlines and record valuations, the real economy absorbs the pressure. Less capital flows to households, less flows to small businesses, less flows to sustainable wage growth. That's how the economy can look strong on paper, while people feel poorer in real life. This isn't a sudden crash, it's a slow financial squeeze. Consumers weaken first, then spending slows, then confidence cracks. Only after that do markets begin to react. And by the time markets notice, the damage has already been building underneath the surface. This is why so many people feel like something is off, because it is. An economy built on rising debt, persistent high interest rates, and asset inflation will always leave consumers behind. It creates growth that looks impressive in headlines, but feels fragile in everyday life. The longer this imbalance continues, the more pressure builds, and eventually something has to give. The real question isn't whether markets can stay elevated a little longer. The real question is how long households can keep absorbing the cost. Because when consumers finally weaken enough, markets eventually follow. And when that shift happens, it happens fast. So when people ask why Americans feel broke in a record economy, the answer isn't confusion, it's structure. Do you feel this financial squeeze in your own life? Let me know in the comments. And if you want clear, no-nonsense breakdowns of how money, debt, and power really work, make sure to like the video and subscribe.